This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny. We are always pleased to have you on with us today. And today we are very pleased to welcome on Atish Davda with EquityZen. It's a very cool concept that they have going on and something that I've been, for my entire career, been involved in the private securities realm in some form or fashion, whether it kind of started out as basically as helping clients purchase private stock in local banks that were near to them, to large insurance companies before they went IPO. And now I'm dealing with, larger scale fintech and biotech industries doing different types of capital raises. It's something I've been very involved in for the majority of going on 13 years of my professional financial career. And one area that's always been a known issue, but really kind of very little in the ways of, solutions that were offered, is what people can do when they have these private securities and maybe want to sell them. There isn't a readily available stock market like you're used to on the New York Stock Exchange or in Chicago or in the Nikkei in Japan. You hold it until something happens, whether there is an acquisition or an IPO, or the unfortunate thing, maybe something doesn't happen. It's inherently kind of the risk with private equity investing. But the problem of not being able to buy, sell, or trade these types of assets has been something very pervasive through, again, the entirety of my career in doing this. And what EquityZen is positioned to try to solve is, again, that kind of marketplace solution for these things. So that's one reason we are very pleased to welcome on Atish with us today. So if you wouldn't mind, Atish, give us a little bit of background about yourself. How did you come to be in this position? Did you start a career on Wall Street at a trading desk? Did you come from another, adjacent industry? How did you become what you are today?
Yeah, for sure. Well, thanks again for having me, and excited to talk about this. Look, by way of quick background, I was born and brought up in India. I came here before undergrad, was pretty fortunate, got a chance to study computer engineering, finance, mathematics, just anything with numbers made sense to me. So I ended up starting my career at a quant fund called AQR Capital, writing algorithms that would trade in lieu of humans doing the trading. This was in the early days of what has now become the liquid alts world. And one of my kind of earliest projects at that firm was to take what was effectively a pension fund or an endowment strategy. You needed at least $50 million to invest, and convert that into a mutual fund, something that my mom with $2,500 could invest using her Vanguard account. And that concept, at the time, I was sitting there scratching my head saying, that's interesting. And in a way that has kind of just stuck with me. I left the hedge fund. I started off as a first employee of a technology company. I also had, a little bit of just a little advisory work helping a few other folks in the technology world. And I realized I was trading in my cash compensation at a hedge fund for much lower cash and kind of this private company stock compensation at these tech companies. And so you fast forward a couple of years, it turns out that, even on paper, my stock was worth 5 figures or low 6 figures, which is a meaningful amount of money. It's a meaningful amount of money to everyone. It was a huge amount of money to me at the time because I wanted to buy an engagement ring for my then girlfriend. And had I worked at a hedge fund, it would have been a little bit easier. But you can't buy a burger with these private company shares. You can't buy an engagement ring, certainly, with these private company shares. And so I, went around trying to see if I could sell these shares. And that's, at the end of the day, a real fundamental part of financial markets is, if there's supply and demand, then why shouldn't they meet and, each party gets what they're looking for. So I was, trying to find folks that wanted to buy my stock. There were folks I found who wanted to buy my stock, but these are securities transactions. These are regulated markets. To conduct one of these transactions, it turns out you need 100 pages of legalese, and you need a lawyer and an accountant and sometimes a banker involved in order to get these trades done. This makes sense if you have $10 million of stock, and I did not. But if you have $10,000 of stock, it was nearly impossible. That was really a personal pain point I had on the shareholder side as someone who held shares of these private companies. From the investor side as well, many people I met said, well, I'd love to buy your shares, but you got to make it easy for me. I don't want to go to jail for, buying it incorrectly. And so that was really the spark that, helped me start a business. So over the last about 12 years, I've been building this business that's now called EquityZen. And I called up my co-founder at the time and I said, hey, look, I have this idea. I've met 100 people like me on the sell side. I've met 50 people on the buy side, but there's not an easy way to get this thing done. And so that's how we ended up building EquityZen, where we're building private markets for the public, not just for the folks who already have tens of millions of dollars.
Yeah, that's again, and that's one of the things that I've always wondered on our pre-call. It was like, you always say like, hey, why didn't I think of that? And again, I'm very happy that someone did and is actually bringing it to market. But it's, again, something that is, not a unattainable like idea to think. It's like, hey, why isn't this happening? And it's always kind of surprising when you meet the people doing it, at scale for the first time. It's like, hey, why wasn't this done before? The need has been there for so long. And again, I'm very happy that it's, starting to come into a position where people can utilize this. So let's start at the top a little bit. It's easy enough for people to kind of think, hey, private stock, okay, this is cool, especially in the concept of, investing in, to pick on someone like Uber or Spotify or someone like that. It's like, hey, well, if I could have invested in them, prior to all the stuff going, as great as it has, that'd be awesome, right? And again, to speak very highly, we can't give tax or legal advice. Nothing that is, what we're going to cover in here should be construed as such. Do your own research, consult with the people that are licensed and able to give you advice on any type of financial transaction. Do your own due diligence, trust and verify. But again, the opportunity is easy enough to identify when looking at the private stock market. But what some people don't kind of realize is why those barriers to entry existed. It's easy enough to say, okay, well, I understand the stock market. It's public ownership of large publicly traded companies. But why doesn't this exist? And it's inherent kind of in some of the covenants that you agree to when you initially buy private stock. There are things called restrictions. Insofar as that you can't just go and say, hey, my neighbor wants to buy this. Let me just, go sign the back of the stock certificate, hand it to them, and great, they now own this piece of this equity. So maybe let's kind of start from initially some of those roadblocks. Besides just finding someone to buy it, as you said, you couldn't buy a cheeseburger, let alone an engagement ring with these private shares. What are some of the inherent issues when it comes to the transferability or the marketability of private securities in general?
Yeah, it's a great question. And look, let's maybe just start off with the absolute basics. If you work in a public company, like if you work at Google, you get your salary, you maybe get a 401k and some other benefits and perks, and you probably get a package of stock options. That concept of allowing the employees to participate in the upside of the organization that they're helping build makes a ton of sense. It allows employees to benefit as owners. Private companies that often stock rich but cash poor lean on this exact same methodology. If you join a company when it's 20 people and someday it's a 2,500 person company, good for you. You helped, you kind of bet on the right horse. You guys worked hard. You got a little lucky, and here you are as a much larger organization benefiting from having been an owner on that part. So it's so fundamentally speaking, it's a wonderful thing that employees of these earlier stage companies, these private companies, get to participate in being owners. Exactly to your point, one of the challenges is, well, a company doesn't want to give stock to an employee, have them work there for a couple of years. If the employee leaves, that's great. They get a chance to potentially kind of remain owners. But here's what you don't want as an employer. You don't want an employee to receive compensation you're giving them in form of stock, and you think the employee owns it, but in reality, the employee's already sold it, right? Then there's a mismatch all of a sudden, because that's not why the stock was provided in the first place. It was provided, the equity was provided in order to align the incentives of the employees and early investors even with whatever success of the company will be the thing that you're incentivized to do. And so that's why these restrictions exist in the first place. You don't just want compensation that's being given to simply, be kind of traded without the knowledge of the company. And so the company is actually really careful about the ownership of who owns that company. That kind of makes sense, right? Just like public companies are careful about who owns what, private companies are also very careful about who owns what. When you have these transfer restrictions, unfortunately, it also means that you have to be very precise and careful and compliant with these restrictions in order to conduct these transactions in a way so that all parties are going to be happy. And again, when you touch people's money, the regulators are involved. So you also have, to make sure that you're compliant by all these laws. And so this is what I was saying. It takes hundreds of pages of legalese in order to make sure that you're abiding by the company's transfer restrictions. The buyer is protected, meaning when they send someone money, they're actually getting stock in exchange, not some IOU, not some funny piece of paper that says, oh yeah, someday I'll give you shares. No, actual shares of the company. And so the seller's protected too. So the seller hasn't just sent over their stock ownership to someone without actually receiving money. So, I'd love to maybe just start off by having folks think about this as a three-sided marketplace. You have the seller of the shares, you have the buyer of the shares, and you have the company, the issuer, in which the shares are being traded. And EquityZen sits right there in between the sellers, who effectively, they may be wonderful engineers or marketers, but they're probably not all securities law experts. And it sits between the buyers, who again, may be wealthy, maybe financial advisors, maybe sophisticated investors, but are themselves unlikely to be securities attorneys themselves. And we work closely with the issuer in order to give them the trust that at any point in time, if they're interested in figuring out, well, who actually owns my shares? Well, EquityZen actually owns the shares, and we will be the counterparty to the seller. We will collect the money from the buyer, and we will sit on the cap table, as we have for over 450, almost 500 issuers at this point. But yeah, these are complicated things. And to your question about why didn't this exist before, well, it wasn't until we built a ton of technology that it brought the minimum investing down to $10,000. If you had $10 million, it's actually a large enough transaction where 1% fee or 2% fee can pay for a lawyer, a banker, and an accountant. But if you want to conduct a $50,000 transaction, 2% doesn't take you very far. And that's the fundamental reason why to do something complex, you need experts to do it. Experts cost a lot of money. And so there was this artificial floor. You couldn't get trades done under tens of millions of dollars. And that's really the innovation, I think, that's taken place in the last 10, 12 years.
Yeah, and also to that, the pool of people that have, a 10 to $20 million investment in a private company, that pool is very shallow. A lot of these people, especially when you're talking about stock incentive packages, granted, some people, do have a lot of incentive, but they're typically on the C-suite level. And, if a company is trying to do something and pursue something in a straightforward trajectory, hopefully you're not getting rid of your C-suite level employees. These are the engineers, these are the sales reps, these are the software dev team. These are the people that are going to be getting, comp packages, maybe at the high end, $250,000, $300,000 of, stock benefits that they might have. And these are the people, again, that are a little bit more mobile in where they go. So, I have, it's kind of like half of my group of peers in college, went out to Silicon Valley, and, I've had, friends that have gone through the Google pipeline and some that have worked for Microsoft. And I've seen this kind of movement of people, and they always bounce the private stock questions off me. And while, the numbers are great, they're not in the tens of millions. And some of these people have even moved up into VP level positions. So talking about just the pool of people is one issue, and then bringing that down, again, kind of to the masses. Again, this is not the masses in general of talking about the general population, but mass is a general term. So let's again look at kind of the barriers and then the solutions that have been solved for this. So on face value, restricted stock. Are there any types of situations where a company could just flat out say, "Hey, we do not want to allow any external trading of this," or is it by law and by definition that you have to allow some portability of these things, or how much can the actual issuer restrict the movement of these shares post issuance?
Yeah, so it's a fantastic question, and the reality is the issuer effectively has total control over how their ownership is maintained and traded. So legally, it's really a matter of what the issuer and the employees agree to. Now here's the dirty little secret, right? There's a massive power imbalance. So when an employee is really excited about joining a company, and they've interviewed a bunch of places and they got a couple of offers and they are accept one and they're really pumped about it. In addition to getting excited about kind of starting, they get again 80 page stack of paper. That's the equity incentive. And again, unless you're an expert at a lot of this stuff, and even if you are, there's just many employees probably don't understand the nuance of what it is they're signing up for. Could you imagine getting paid in a currency besides the US dollar and not actually knowing the exchange rate? That's what's happening in a lot of these cases. Mm-hmm. So first and foremost, there's a lot of education that needs to be done. And I have to say, over the last 10, 12 years, especially that we've been in business, not only from us, but generally in the industry, including the companies themselves, they're getting a lot better about explaining to the employee and kind of managing expectations properly about what it is that they're accepting as compensation. But to your your main question about what is it and who controls the power, is like the issuers absolutely and I would say rightfully want to make sure that they understand who is on their what's called the capitalization table, cap table, who actually owns the shares. And many issuers, including many we work with, will often say, "Hey, EquityZen, we've worked with you a bunch. Right now in the middle of a financing, so we're not going to approve any secondary transaction." So, for example, if the company's getting ready for an IPO, they're not interested in conducting a bunch of secondary transactions. If they're about to just go raise their Series D, they don't want other price-setting transactions taking place. Because what you don't want, in a public market, it would be pretty odd if a company traded at $15 on Tuesday and at $60 on Wednesday. And that might be okay if there was a big run-up, but in private markets, there's a lot less liquidity. There's a lot fewer transactions. And so companies will often work with us and say, for the next month, we're not going to approve secondary transactions. We're in the middle of a financing round, or we're about to go public, or we're in a quiet period, or what have you. And that right there is really the key, I would say, why we've been able to work with, again, almost 500 of these issuers over the last decade. We're not the first ones to have thought about this problem. 10 years prior to us, being around, there was a company called Second Market that used to do this. The challenge with the prior generations that tried to solve this problem was twofold. One, they were really just trading in 5 or 6 companies. Back in the day, it was Facebook and LinkedIn and Groupon and Zynga. That was really it. There wasn't a big, deep bench of unicorns. But the second more important problem, I would say, is issuers, the companies, they weren't getting a seat at the table. A traditional marketplace people think about as buyers and sellers. And if these two agree, boom, you're good to go. That's not how it works in private securities. The issuer, it's ultimately their ownership that you're trading. And so if you think about it from the lens of a landlord, if you own an apartment, you don't just want, and if you rented out the apartment you own, you don't just want the tenant to just themselves decide who's going to live in your apartment, right? If the tenant wants to sublease it out, most landlords want to know, hey, who's going to be living in my property? Are they going to take care of my stuff? Are they going to abide by the rules that we've agreed to? And in many ways, that's really what the companies are after. Are there some companies that shut it down altogether? Sure. But the vast majority of companies, especially over the last 4 or 5 years, there's really been the sea change of no secondary transactions to secondary transactions as long as we get a seat at the table. And that's really how we've been able to really earn the trust as a partner to a lot of these issuers.
Yeah, and I would also imagine not just from the standpoint of a pricing issue as it pertains to either pre-IPO when they're trying to consolidate outstanding shares or some type of additional capital raise where you don't want price dilution or inflation. I'd imagine also the other issue would be again to that point of your cap table, not wanting to have massive allocations and kind of position yourself for a hostile stock takeover. Just having someone be like, okay, secondary market, and then I swoop in and be like, hey, I now own 30% of your company. Again, there's a lot of issues that can be kind of that, are that people don't necessarily think about from the broader context of a public market, that when you have a much smaller pool and you're talking about non-public capital that can crop up in a bunch of different ways. And again, to the point of having that intermediary position like you do really helps to solve that. And another part that I think would be a good transition now is saying, okay, this is what the perspective of why the restrictions are placed on it by the issuer. Obviously, we have a bunch of different reasons why a owner of those shares might want to trade. To your point, they just want cash money in their hand. Secondly, maybe they would like to better position themselves for a new company they're at, and they need money to participate in this new offering that's going on. But again, you talk about these parties coming together. So when it comes to that, and I shouldn't say I think the general consensus of people thinking about this is that they don't think about the issuer kind of really being there. They think about the holder and the buyer. When you think about any transaction, you think about, hey, I have something, you have something, there's a market here. I give you my dollar for goods and services, you give me a stock certificate. Or that's really not how this works, or at least works to any great degree of effectiveness. So explain a little bit kind of how you've structured this general, and again, I don't know the best terms. I'm going to call it a marketplace. Correct me if I'm wrong, but the marketplace that you have created for this, explain how these parties and the counterparty relationship kind of works to solve these issues.
Yeah, and you're spot on, by the way. We do call it a marketplace. And exactly as you said, most people think about a marketplace. If you go to Etsy, right? If you want a mug with a kitten's face on it, and there's someone else that makes a mug with a kitten's face on it, Etsy will just allow you to trade and it's all good. That's how most marketplaces work. That's the concept most people have in mind when they think about a marketplace. EquityZen has, one of the reasons it takes, in our case, 10 plus years, and in this industry, really, we're one of the only ones that have built this issuer-friendly, reputation. It takes a long time to build a three-sided marketplace. It's really this triangle that we sit in between. You have the same two sides, the sellers and the buyers, but again, you have this third kind of node in the triangle, the issuers, where they don't want to get in the way necessarily, but they do, exactly for reasons you described, want to know, hey, who's my owner? Who owns shares in my company? Who could potentially vote people onto the board of the company? Who could potentially vote to change the management of the company? These are pretty reasonable stances that companies take. And so it's not necessarily that they want to get in the way of the employees wanting to cash out to buy a house or an engagement ring or pay for a vacation or what have you. It really is more just hey, how do I make sure to solve this problem at scale? Because for any individual transaction, they probably don't have an impediment that they want to throw up. It's really, how do we solve it at scale? That gets in the way. And that's really where EquityZen has positioned itself to build a solution that can work at scale. Here's how. We collect interest from a bunch of sellers. So these are employees, these are early investors, these are even hedge funds that have invested most recently in the most recent round, and they want to rebalance their portfolio. At any given point in time, we almost have an order book on the sell side. And then we have an order book on the buy side. And in public markets, usually the order books tend to touch exactly where the stock is trading. In private markets, there's often a bid-ask spread. So the buyer wants to pay no more than $10, and there's many buyers who want to pay less. The seller wants to accept no less than $12, and there's many sellers who want more. And that spread between $10 and $12 is the reason why there's not hundreds of trades happening every day. It's one of the reasons why. And when buyers and sellers agree, okay, yes, let's agree on trading at $11, that's really when EquityZen works with the issuer and saying, we have 5 sellers, 50 buyers. They want to transact in your company's stock. We already are a cap table entry of yours. We've done many of these transactions with you. Here's another one that's coming at $11. Because of that relationship that EquityZen has established with the issuer, from the issuer standpoint, the company standpoint, they can feel comfortable. Okay, EquityZen's a good reputation. They're making sure that the buyers and sellers are, entering into contracts that are compliant, not only with the company's transfer restrictions, but also with the regulation that FINRA, SEC, all the various kind of regulators have been putting on the space. Again, it's a securities transaction. This is not appropriate, really. These are private stocks. They're risky. They're illiquid. They're not appropriate. My mom should not be investing in these stocks. If you're a financial advisor, if you're, a sophisticated investor, if you're a family office, or if you're an accredited investor and have familiarity with the space, like maybe you've been doing a bunch of angel investing, and that's great. But now you're looking for diversifying your venture portfolio, not just with the earliest bets. Basically, there are lottery tickets. Maybe you'll hit some, many you won't. But you're actually investing in this kind of risk-adjusted section of the company's life cycle. Not the earliest ones where who knows what could happen, but they've been around for 8 years. They're probably going to be private for another 2 or 3 years before they go public. And so from a risk-adjusted basis, there's a lot less access to these companies. Public companies, anyone can invest. The earliest seed stage companies, if you're an accredited investor, you can invest. Again, it's the earliest stages, but it's really hard to get access to as you said, the Spotifys and Ubers before they go public. It's hard to get access to. And so the issuers effectively get to say, okay, EquityZen's getting the demand, EquityZen's collating the supply, they're already on our cap table. Because we feel comfortable that an above board brand has been conducting this regulatorily kind of scrutinized work, okay, now we feel comfortable kind of authorizing a transaction. And again, exactly as you said, Alex, it takes time. It's a tricky thing to have to build, but once you build it, that's kind of the power of the marketplace. The flywheel kind of keeps spinning, and trust builds upon itself because we balance the interests of the buyer, the seller, and the issuer, rather than being paid by only kind of one side of the triangle. If you think about a different type of business, a fund, if you will, it's effectively only representing the buyer. It wants the cheapest price possible, kind of doesn't care what the company thinks about it. It just wants to pay as little as possible for the shares. That would be an example of a business that's aligned with one side of the 3 sides of the triangle. And EquityZen has really worked hard to balance all 3 so that we're not getting paid only by one side and potentially jeopardizing the trust that the other 2 sides want to place in the marketplace.
Yeah, that's a really great point. One thing that you really brought up that I really like to kind of hit on is the positioning of time when you would potentially be getting involved, because you brought up risk-adjusted positions, whereas it's there's a high delta on the risk to stability of something that's just starting out, unproven, pre-revenue, all the kind of big keywords that go into, hey, it's just 3 people in a garage, right? It might be the next Microsoft. It also might be that they go back to working for the respective employers.
It might be a good lesson.
So from the position of kind of where you would step in, I'm sure it was kind of one of those things where it took some trial and error to kind of figure out, hey, we don't want to be in the position to where we're creating a marketplace for stuff that is going to be high frequency and extremely high risk, but also what's the point in getting into where we're positioning ourselves with a company that's, a year away from going public, and we don't really there's no meat on it for us to really be able to create that market to facilitate these trades, because that's where you make your money. That's how you keep the lights on, is facilitating these trades. If there's no, actionable transactions happening, well, you have a great concept, but again, you might be going back to work for that quant firm soon if that was the case. So tell us a little bit about kind of how you developed kind of your avatar of saying, hey, here's when we want to try to engage with people. And is it different for different sectors? Or again, I'm sure there's a bit of a floating point depending on who you're dealing with, but that what I would seem to be like kind of a big key of figuring out when you want to try to plug in with these companies to create that marketplace for them.
Yeah. And I'm so glad you brought this up. EquityZen got started really in concept concurrently when the Jobs Act was hadn't even passed actually. I'm friends with some of the folks that at the time were working on the Jobs Act, and back at that time, really, for most of us that were not extremely wealthy individuals or institutions, the only place where you could get exposure was the public market. And so there's really kind of two key concepts to talk about here. Number one, public companies have been at an all-time low for about the last 50 years. So for the last 50 years, there's been almost a continuous decline in the number of issuers that have gone public. This accelerated after the post-dot-com boom kind of Sarbanes-Oxley regulations, but it's actually been going on way prior to that. And so if you're a public market-only investor, you've effectively just had all your bets by default get more and more concentrated. You used to have 7,000 names to choose from. Now you only have 3,000 names to choose from. And let's face it, there's only a small number of companies that are the largest market, that are driving most of the market cap. And so any kind of market cap weighted index is, again, just skewing you more and more into a small number of highly concentrated funds. That's okay. There's nothing wrong with that. But it does take choice away from the investor. And so right around, again, 10, 12 years ago, when the Jobs Act was just about to come out, there was all this excitement about angel investors starting. What you effectively had was a bunch of folks who could only invest in public markets. Companies were going private way later, right? The typical company was going private. This is 10 years ago I'm talking about. By the time they were 9, 10 years old, the company was. In the dot-com era, companies were going private when they were 3, 4, 5 years old. Amazon was a 4-year-old company when it IPO'd. Today, a 4-year-old company is usually raising its Series B.
Did you mean to say companies were going public after 9 years?
Yes, exactly. I'm sorry about that. Companies that were IPOing or companies that were going public were in the 9, 10, 11 years range, as opposed to back in the dot-com era, so about 25 years ago, they were going public when they were 3, 4, 5 years old. Amazon, again, perfect example, went public when it was 4 or 5 years old. Today, a 4 or 5-year-old company is just raising its Series B round. And so what does that mean from the perspective of the investor? It means that if you can only invest in the public market, you're basically losing out on all the value that's created from year 0 through 10. And that was really one key insight we had, as we said, okay, it makes sense that more and more people are going to invest in the private market. But to your point, Alex, the way we figured out where we really wanted to focus our time and energy was saying, well, there's going to be a whole bunch of companies focused on seed stage investing. There's going to be all these companies, all the crowdfunding platforms that are allowing accredited investors to invest in seed stage rounds, becoming angel investors, and that's great. Now, we did not want to compete in that space for a couple of reasons. One, there were going to be a lot of companies, so it was going to be saturated. But two, and this is the kind of the key second insight we had, we're going to have a bunch of people who are used to operating in the public markets, who can buy a stock on Monday and sell it on Thursday if they really want to, meaning it's a super liquid market. And they were going to all of a sudden find themselves in a highly illiquid market. They were going to invest in year 0 of a company, and if the company survived, by year 5, they're kind of saying to themselves, well, when can I get my money out? And the company is saying, oh, we're just going to raise our Series C now. We're not going to go public for a while. And so all of a sudden you have all these people who on paper have made millions of dollars potentially, but they can't do anything with it. So it's not just the shareholder, the employees. We at the beginning of this, we talked about some stories of the shareholder wanting liquidity, but it's also a lot of the investors. The investors that are holding from years 0 through 5 are all of a sudden saying, I'm great at early stage investing. Can someone cash me out at year 5? And the best part about this is we realized that Well, sure. There's actually a lot of people that don't want to invest in year zero, but that see value in investing in year five. Right? They don't want to just invest in the, as you said, three folks in a garage in a pitch deck, but they want to invest in a company that has product market fit, but hasn't yet scaled quite a bit. So that's our segment. So we said, look, we want to operate in this years 5 to 15 life cycle of a company. And then, we kind of allow the prior segment to get liquidity, the 0 to 5 year folks to get liquidity. You still have all this capital appreciation happening in the private market. And then by the time the company goes public, that's when the masses get to invest in it. And so we kind of identified this, what we think is a risk adjusted reward that's attractive, because not that many people have access to it, but they're still proven companies, but not yet available to the whole world.
Yeah, and I think that's attractive for a lot of people. And I again, in my position of what we do for the retirement plans, it's trying to educate people enough to make sure that they understand, have enough information to make an informed decision about what can be a very risky investment for very early stage companies, and the ability, to do that. Again, there's a lot of competition in that space. I won't name any names, but there's a lot of big names out there that put together different offerings, whether it's be under Reg D or Reg A, especially for the non-accredited, and kind of for the masses that was brought into effect by the Jobs Act. Which, again, I am a firm believer in the concept of the democratization of private finance. People investing in things shouldn't just be limited to the public stock markets. People, if they have the wants and ability, should really be able to put their funds wherever they want to. It's kind of, going back to the core tenet of us as a country and the markets that we've built, the freedom to do what you want. Granted, there should be regulation, there should be protections put in place. But again, understanding what you're doing at the end of the day falls to the investor. And only having kind of those two buckets, the middle ground, I feel, is very important. So having the ability to kind of get into that risk adjusted position, private equities are inherently still going to be, painting with a large law of averages, riskier than a public market. For the simple fact of liquidity, if something starts to happen, you have an easier out with a public market, and two, just for the fact that it's not as proven as something else that's on a public market. So again, not to kind of just play the trumpet of what I think is good and well in the world, but that's again kind of a key component of what I think people need to take away from this, is that there are different segments to this private market. You don't just have to be someone that is on the inside of that walled garden, knowing someone that works there, being an angel investor and bump into someone at a conference, or go the route of someone that's just doing the kind of higher volume seed state investing, where that's under Reg D or Reg A or some type of amalgam between the two. Now, what I'd like to kind of get into is a little bit of the functionality. And it's something that I didn't quite understand when you said it. Again, I think I do, but I never want to speak for my guest, is how you fit into this. Now, you mentioned that you plug in onto the cap table. So in this, again, the triangle that you were talking about, you have the buyer, the seller, the issuer, and then EquityZen kind of sitting in the middle. So when you have, again, I would imagine that first you're doing more of the corporate approach, or I'm sure there's probably, you can kind of get into the specifics of it, but you have someone, an issuer that wants to get on board with you. Do you in turn plug in with the other people, and then they convey the shares to you, and you act, again, without a better term, kind of as escrow for that? You take it in, they're titled to you, you go on the cap table, and then when the parties agree, because there's no necessarily bid ask in that spread, when it both comes to agree, say, okay, fine, I want 10, I want to pay 12, and when it finally meets that equilibrium point, then you say, hey, look, we have a deal on the table, everyone signs off on it, and then the shares are conveyed. So again, maybe talk a little bit about the functionality of how you specifically work.
That's great. Let me give you an example. At any given point, on a no names basis, because we don't want to talk about specific companies or issuers at this time, you have, let's just say, a company that's worth $2 billion at the moment, as of its last round, 6 months ago. It's got, 800 employees, and it is, just for the sake of convenience, let's just say it's a B2B company, so it's not a consumer facing. Okay. So you have this company, it's got 800 employees, it's raised, its series. call it its Series D already, and it was last worth $2 billion. Okay, so that's the picture. Now, EquityZen likely already has some relationship with the company. Let's say the CFO is familiar with EquityZen from a prior company he or she was with, or the general counsel had used EquityZen in the prior company she was with, or what have you. But let's just say that there's some a familiarity with the secondaries market. Anytime employees of that company or shareholders of that company are looking for liquidity over the past 6 months, let's just say, at some point came onto EquityZen.com, created an account, and said, I own equity in this company, I own this share. There's a whole flow that our platform will walk you through, and you fill out the information and you say, okay, it looks like based on the current market, the shares I own are worth approximately, I own 10,000 shares and they're worth, between $10 and $12. And so I own such and such money. And we collect that information from dozens, if not hundreds, of shareholders of each company. So that's the sell side of the order book. At any given point in time, we likely have an order book on the sell side where you have a bunch of people who say, I'm willing to sell 1,000 shares at $10 and 5,000 shares at $12 and what have you. Similarly, we have all this data on the buyer side, on the investor side, who says, I would love to invest in this company. I work at a different company. We use this company and this technology. I'm a big fan of this technology. I think it's going to be the next Salesforce or what have you. Great. Then they can start investing putting in bids on our platform saying, I would love to invest at $9. I would love to invest at $10. I might be okay at $11. And so we collect all these bids on the sell side and we collect all these bids on the buy side. And effectively, we have this order book where as soon as the bid-ask spread starts to close, and this is just a function of time. Usually as time goes on, you have more and more people who want to either sell or buy, and eventually the bid-ask spread closes. Or there's news in the company. The company announces that they just going to hire a new executive whose track record shows that the company is probably getting ready to IPO in the next couple of years. Great. So either because of news or just because time has passed, the bid-ask spread starts to close, and all of a sudden you have, again, agreement at the $11 price range in this example. Our platform, before it even reaches 11, has already contacted kind of the parties and said, it looks like there's going to be a transaction in this name. Can you confirm that you actually want to participate somewhere within this range? And then we start with this, you end up with a specific price, and all of a sudden, you kind of need three things to get a deal done. You need a specific size, you need a specific price at the same time. And the moment all three of these are about to happen, we've already engaged the company and we said, hey, look, we're about to send you a transfer notice. It's at this price for this size. It's the same EquityZen that you know and love, and we think you'll get a transfer notice sometime in the next 2 weeks, sometime in the next week. Hey, it's coming tomorrow. And by the time the issuer, the company actually gets our transfer notice, they're already kind of familiar with kind of how this whole thing works. And so we, at all times, just collect this buy side and sell side data on not just the one company that we're talking about, but the exact same market, if you will, is being captured for over 100 companies. And so whenever these markets show, indicate there's about to be a trade happening, we will go and engage with the company. That's exactly how we keep doing these transactions, by collecting data from the sellers, collecting data from the buyers, making matches, but always getting the issuer's approval on every one of these transactions. And this is what I was saying earlier, Alex. Sometimes the issuer will say, hey, I know you're about to get a match, but we're about to kick off a fundraiser. We're about to close a fundraise. So for the next 30 days, please don't send any trades to us. And that's where the dialogue happens, which is why there's, again, some trust that we've been able to develop with issuers as a friendly partner that still wants to, build a thriving private market.
Sure, and that definitely makes sense. Now, how much kind of, how live, I would say, is the market with regard to setting pricing on that? Is it something where, the buy side of the table can say, hey, you know what, let's say I think this is worth a little bit less, and they put in a slightly lower bid, and then the seller side saying, hey, I think this is worth more. Like how kind of dynamic is that between everyone, or is it something that's updated? Again, how often is updated? How dynamic is that kind of pricing to get that equilibrium of bid ask to match?
Yeah, it's definitely measured in days and weeks as opposed to minutes and seconds like we're used to in the public markets. So what will happen is the seller will say, hey, okay, I know EquityZen, I know your platform is showing me that there's probably not going to be a ton of demand at 12.50 a share, but I really want to sell at 12.50 a share. Cool, that's your choice. You put it in at 12.50. Probably 2 weeks go by, and if you don't get a lot of demand at 12.50, which is likely because the platform using the buy side kind of indicated that it's not going to be very likely that you'll get a ton of demand at that price. That's when the seller says, okay, look, it's been 2 weeks. I didn't get a lot of bites. Fine, I will come down to, $10.50. Okay, at $10.50, we're showing that you're probably going to get, I don't know, $250,000 of demand. Maybe you get 400K of demand because it's below the $11 mark that we, again, think it's going to cross. In that case, a lot of buyers that were willing to pay, say, $10, but see an offering at $10.50, say, yeah, okay, $10.50, 5%, difference. I'm projecting a 30% increase in the stock in the next year. I can eat 5% to lock up supply right now. And so within a matter of weeks, these orders tend to iterate. In some cases, it's days, but it's usually a matter of weeks. But what it's not is in the public markets, the exact same thing happens multiple times a day. So the way you have like a limit order in a typical public brokerage is the limit order expires at the end of the day. We like to think of in our world, these orders expiring, you can think about it like at the end of the month, because 4 weeks is actually a long enough period of time where all the iterations are likely going to happen, and then you end up with either a match or a lack of a match.
Yeah, so it's not like a filler kill kind of scenario where it's again it's a little bit more long term, and there maybe isn't necessarily even a best word for it. I would think, it's something new, which again I love when I can talk to someone that has something new and just how it's a dynamic market order. That'd be the best way I could describe it. There's price fluctuation. You have people coming in at different points in the whole stack.
Probably most exciting point is if you want to invest in technology, you can invest in public company technologies that range from the Microsofts and the Apples that do everything to very specific kind of niche technology companies. On the private side, you can really invest in themes. You can invest in, whether it's AI or the future of food, or a couple of years ago, the most exciting ones were fintech. Right now, cybersecurity is, kind of continuing its popularity. Regardless of whatever theme it is you're investing in, what you tend to see is the dynamism of the market. It becomes very active by theme as opposed to by a specific issuer necessarily. And that is something that candidly 8 years ago, 6 years ago, just wasn't the case. 6 years ago, it was like, let's see if there's any demand in this name. Let's see if there's any supply. But zooming out a lot, right? Well, let's bring people to kind of like marketing 101. If you think about the customer adoption curve, it takes a long time in many cases for products, in this case, an offering, to really solidify for the masses. So I would almost say that the last 10 years have been the business cycle that the early adopters have really adopted and embraced this market cycle. The next business cycle, meaning the next 8 to 10 years, will be when kind of the early majority takes over. So we already saw a lot of activity in the last 10 years, and that was from, 3% of the pool of potential market participants. And even in the next 10 years, I think we're only really going to get to, 20, 25% of the market participants. Like the masses are not really even going to take over probably for the next, like the 2035 or onwards, which sounds bananas when you think about it, because we're talking about 10 plus years away. But that's the power of this, is like we're talking about a massive secular shift happening into, exactly as you were saying earlier, Alex, adoption of alternatives, not just the wealthiest accessing it, democratization of access. These things take time. And again, because it's a regulated industry, you don't just want people to lose their shirts over it. There's what I would say are probably healthy hurdles in place that ultimately, may seem slow in the moment, but are probably good for the overall population. And so again, there's just it seems dynamic now, and I think 10 years from now we're going to say, oh yeah, of course, this is part of my portfolio. But right now, many people are going from zero to non-zero in terms of allocation in this portfolio. So there's going to be some education involved. There's going to be some comfort building involved, and that's okay. That's part of the reason why we try really hard to kind of take a long-term approach on this thing, because there's, I don't know, 20 years of tailwinds on this particular asset class.
Yeah, and I think you brought up something that's also really interesting is at least just exposure to different segments of a market. You talk about the much more broader sense, and to pick on cybersecurity, you look at companies such as, look at like Siemens or Booz Allen, and, yeah, they're big into that space. They have segments, but they're also conglomerates. They do so many other things. And to be able to invest to use kind of a manufacturing scenario. It's like you're getting to invest in the people that are making the new part that's going to drive this machine, as opposed to the machine that, yeah, they'll buy the part eventually, but they're kind of doing it on their own now. It gets you exposure to that whole investment stack. The back end of what makes these huge multinationals and these conglomerates run when they, acquire or buy out. And that's a whole other strategy for this. It's not just IPOs. There's a whole positioning to where these things get bought out, and typically at pretty favorable terms, because they don't want them to get bought. Booz Allen doesn't want them to be bought by Siemens, or BASF wants to buy someone else before the other person does. So, that's a whole other part of this market. And again, I do have to kind of cut this off. Unfortunately, I could talk to you for probably another hour or days on end. I really enjoy this stuff. It's one of my favorite parts about my job. But again, that's just one thing I wanted to kind of iterate on. What problem this is kind of solving in the marketplace is the ability to, invest into the trends before they kind of make it to the mainstream marketplace, and many other different things. So with that said, any closing thoughts that you have on kind of our conversation today? And if people want to reach out, learn more, kind of figure out exactly what EquityZen is doing and how it could plug into, maybe them engaging with you, how can they contact you?
Yeah. So first things first, I think, EquityZen.com, you can go there and just get familiar. Like I said, education is really important. We put out a ton of great content. Even if you're not sure you want to invest, all you want to do is kind of just learn about this space. No worries. Just put your email address in. You'll get some content. And you never know, you may find something that's interesting and say, you know what, this isn't for me. Or you may say, oh, that's pretty interesting. This may be relevant for me a little bit later. So just one fun fact on that one, we recently had our, someone invest for the first time 9 years after signing up. I mean, could you imagine signing up for DoorDash and not placing your first food order for 9 years, right? That would never happen. But here, we see that. And again, it kind of goes back to what I was saying. These are long-term trends. And so, education is kind of step one, is what I would say. Is to like, forget about investing. Just learn about it, right? Just learn about it, because, 10 years from now, it's going to be commonplace. So if all you want is to get familiar with the space, with thinking, like how people are doing this, you can find some of that on EquityZen.com and just go to our knowledge center. I would also say, for the folks who are a little more curious or a little more familiar with it, check out the FAQ. Even if you're just investing in other asset classes, it's actually a fantastic way to learn about how this particular segment of the market works, and therefore to educate yourself on other parts of the market. And finally, for anyone that wants to kind of connect directly with me, you can find me on LinkedIn. My name is Atish Davda, Davda. There's not a ton of Atish Davdas on there, so you'll find me pretty quickly. But I think, and maybe Alex, I'll kind of turn this around and kind of just say, one of the reasons we got connected and we think there's kind of good, mojo here is also because these are long dated, illiquid securities. Something that people should consider investing in via their tax advantage accounts. Especially if it means that it's not money they're going to need a week from now or even a year from now. There's probably some tax advantage solutions out there that I'm sure you can educate them about a ton.
And I would be more than happy to. But with that said, we are certainly coming up to the end of this. I said this to all my guests, but especially kind of pertinent to what we're talking about today. The most valuable resource we all have is our time. We can't make any more of it, especially even if we make the best investments in the world, can't make any more time. So again, Atish, thank you so much for spending some of your time with us today. To everyone else, thank you so much for joining with us. We greatly appreciate it. I hope you found this interesting and engaging. Thanks for watching, and tune in to the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.